The following program is sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
It's Friday afternoon, and we're going to be talking about money. You know, one of the things that's coming later in the program, I want to talk about Charles Lindbergh and the Spirit of St. Louis. How did that all come about? You know, we all know what the end of the story was, but we don't really recognize what the beginning of the story was. That's coming. I want to tell you how it began because I think it has impact on what's going on today. Some things that are going on, very interesting and interesting in terms of investment impact. I also have a guest who has a very interesting story to tell. You want to hear what he has to say. But I want to start, you hear this comment a lot of the time, the market is telling us, you know, don't fight the tape. Look at what the market is doing. You know, I've been reading the book now, The Money Game by Adam Smith, book written in the 1960s, and there's so many similarities between that time and this time. The 1960s were right in the middle of that period of time when the Dow in the 1940s had hit 100, began to climb, and by 1966 would hit 1,000. It grew tenfold between 1941 and 1966. And Adam Smith wrote his book during that time. I talked before about the kids market, which is where we were. But, you know, he also points out about the crowd. Now, in 1895, Gustave Le Bon wrote a book called The Psychologie des Fous, which in French means the psychology of fools. It was long before Stalin, it was long before Hitler, long before Mussolini, long before those times when those leaders rose up with that kind of crowd psychology. Crowd isn't just in one place, it wasn't just in one square. A crowd is a collective mindset. People feel the same way, they act in the same way. They act almost in a state of isolation. They begin to feel that it's almost like they have invincible power, invincible knowledge, a special knowledge that goes with the crowd. It's, you know, when you look at the history with Hitler, with Mussolini, with Stalin, there was almost a hypnotic trance that they fell under. Le Bon wrote about that long before they came into being. There's also a fascination that goes with the crowd. But there's other aspects that go with a crowd that apply today. The crowd doesn't really reason, and it's very, very susceptible to images. When you look at the images, it's not about reason, it's not about logic, it's the image that counts. There's almost a magical power of the symbols that are painted by the crowd. Don't fight the tape. Don't think about it. Don't push back on the tape. Can you imagine? Think about that in reality. Take it literally. Don't fight the tape. What does it mean? You know, the ticker tape coming out of the ticker machine. You're going to stand there and try to push it back into the machine? No, it's talking about the stock market. If the market is moving a certain way, don't fight the tape. And there's a little bit of logic to it. If you compare it to the weather, if it's sunny today, there's a higher probability that it's going to be sunny tomorrow than it's going to rain. There's a higher probability if you have snow on the ground that the next day it's going to snow. But the probability is not 100%, and yet people take it almost with 100% of reason. You know, I can remember the economics textbook written by Samuelson. Samuelson was the economics professor at MIT, wrote the most popular economics textbook in the 60s and 70s. And part of one chapter, the introduction to one chapter, says that the stock market has correctly predicted 9 of the last 5 recessions. Think about it. It's correctly predicted 9 of the last 5 recessions. What he's really saying is people that depend upon the stock market and what the market's doing and what the market is trying to tell them as the market goes down, is it trying to tell them there's a recession? What Samuelson was pointing out is it's not the market. The market doesn't tell anybody anything. The market doesn't have a voice. The tape doesn't have a voice. They don't have an intelligence. They're inanimate objects. If you look at the reality, if somebody buys a stock for $40, what they're buying it for is because they expect it to go up. Why does it go up? Not because you own it. It doesn't care. It doesn't know that you own the stock. It goes up because of earnings and growth and the things that are going on to make the company larger and better. If it goes down, the opposite's true. People don't buy a stock expecting it to be $40 today, $40 tomorrow, $40 10 years from now, $40 50 years from now. They buy it because they want it to go up. But that stock does not know that the person owns it. It's not the stock that knows where your break-even point is. I've heard people say, I've been in this business now for 30 years, and I've heard people say, I'm just waiting to get back to break-even. Stock doesn't know where you bought it. It doesn't care if you're going to break even or not. The stock is going to move because it's an auction market. It's going to depend upon who buys and who sells. It doesn't know you exist because it's inanimate. It's no more an object. It doesn't know any more about you than a bottle of water or a rock that's sitting on the ground or the chair that you're sitting in. It doesn't know that, but people ascribe this kind of crowd psychology to it. The market doesn't predict anything because the market doesn't exist. The market is what it is. It's inanimate. But people feel comfortable being part of the crowd. And that's the point of what Adam Smith was trying to say. He was trying to say that people feel comfortable. People feel good about buying stocks when they're up. My perfect stock, if somebody was 20 years old or 30 years old or even older than that, and they wanted to buy a perfect stock for retirement, if you knew the stock you were buying at $10 was going to grow to be $1,000, the perfect stock is one that you can continue to buy during 30 or 40 years at $10 a share, and then 3 months before you retire, that stock goes from 10 to 1,000. That's perfect. Your cost basis is 10. And all that money you accumulated during all those years, you bought at 10. And suddenly, overnight, your net worth in that stock grows 100-fold. That's perfect. But people tend to be part of the crowd. They would much rather buy a stock today at 10 that tomorrow goes to 800, and then for the next 20 years just slowly creeps from 800 up to 1,000. They're giving up almost 100-fold increase by doing that, but they feel better about it. Think about the people in some of the stocks that have done very well in this area, and people become enamored with those stocks. They fall in love with those stocks. Those stocks don't know that they own them. The stocks don't know anything about the person that bought it. The stocks just generally move based on how well the company does, at least over the long term. But people feel comfortable being part of the crowd. So that brings me to a second point, because there was a survey done by Cerulean Associates. Cerulean Associates came out with a survey, and they found that the centralized units at brokerage firms, the back office, so to speak, they outperform financial advisors over the last 5 years. Now, if you look at the back office who's developing models, their model over the last 5 years, all things considered, have returned an average of 6.45% for those years. 6.45. Financial advisors, on the other hand, have averaged over the last 5 years 5.99 for that same period of time. So the performance is a little better by relying on the models from the back office. 6.5, 6.45 versus 5.99. But when you look at the Standard & Poor's over that period of time, the Standard & Poor's during that period of time was up 15.5. Not 6, not 5, 15.5. If you look at where we were at Adams Financial Concepts, we outperformed the market because we were up 16.7, but that's neither here nor there. If you look at what's going on, the idea is people feel comfortable with their financial advisor. They like the person. And as I was going through and working for the large firms, the idea was to sell the relationship, not the performance. To make people like you, to make people really build a relationship, not to look at how well they were doing. So the idea is to come back to this idea of the crowd. It's to be comfortable and to feel that you're doing well. The reality is you're giving up a lot of money that you could be making. We're going to come back to the same subject after the commercial break, so don't go away. The impact is very large, and I'm going to be talking about dollars and cents when we come back. Don't go away. We've got a great guest. We want to talk about Charles Lindbergh. I'll be right back.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your 7-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
So I was talking about the crowd and the feeling of comfort you get with a crowd, and how Cerulli has done this study that shows that the back offices of the large brokerage firms are developing models for financial advisors to use, but even on their own, financial advisors are getting about a 5.99% return, and the back office models are yielding a 6.45%. You know, the logic behind that whole thing is to reduce volatility. We've just gone through 2008, 2009. We hear this thing. The one thing you don't want to do for clients is lose them money. You know, the fact is we live in a volatile market, and we saw that through 2008, 2009. But the focus becomes on the short term instead of the long term. If you're involved in the stock market, the focus should be on the long term, what you're going to do over the long term. Not what's going to happen next week, not what's going to happen next month. But over the long term, you're trying to build wealth. You're trying to preserve wealth. You're trying to build during that whole period of time. And those actions which are taken to reduce volatility, to reduce risk, don't really reduce risk, in my opinion, at all. So you take, if you compare, for example, and I did compare because I like to compare my own numbers to what everybody else is doing. I'm a very intense, competitive person. So if you look at what the numbers look at, over 5 years, If someone would have started 5 years ago or at the beginning of 2009 with $100,000, the average the amount they would have received, getting the average return of financial advisors, that would have grown from $100,000 to $126,200. And if they'd taken the models from the back office, it would have been a little more. It would have been $128,405. But $100,000 invested with me, and of course, past performance is not indicative of future performance, but during that same period of time, it would have been not 120, but it would have been 184,000 instead of 128. If that had happened and today the market dropped 33%, someone would still be ahead. That's looking forward, looking long term, not short term. And if you look at 10 years, over a period of 10 years, using the financial advisors' numbers, over 10 years, that 100,000 would grow to 168,000, assuming the same kind of return. At getting our return, it would have grown to 395,000. The market could drop between 50 and 60% and still be ahead. And if you look at it over a really long period of time, over 25 years, using what's coming out of a regular group, out of a financial advisor, out of a back office, 100,000 would grow to 407,000. But growing just by the amount of the index, you grow to over $4 million. That's a tenfold increase. It's a very big difference. All of that shortfall is due to trying to protect the downside, trying to keep from watching accounts go down rather than looking long term. And it's something where if stocks are going down, if you go back to 2008, 2009, the time of the Great Recession, stocks were down 37% in 1 year. At 37%, that's huge. That's scary. And I was scared. Stocks were going down. But when you think about it, in real terms, if you're not owning those stocks, if they don't return and go up, if they're going to go down to zero, if those stocks go to zero, it doesn't matter anyway. The economy is coming apart if all those stocks go to zero. So why not ride through the ups and downs? It's something that we've seen. Dalbar does a study, and they look at mutual fund investors over the past 30 years. And they showed that the average mutual fund investor during the last 30 years got a return of 3.69% versus the market, 11.11%. Or in other words, a person that started 30 years ago with 100,000, the average mutual fund investor would have grown 100,000 to 286,000. Now that sounds pretty good when you think about it. 30 years, 100,000 to 286,000. But had he invested just, or she invested just in an index fund, it wouldn't have been 286,000. That 100,000 would have grown to $2.1 million. It makes a very, very big difference. That's the difference between focusing on the short term and looking at the long term. And there have been studies, and we don't have time to go into them, I will at a future time, that have talked about being in the market versus trying to guess and time the market. I think Jack Bogle of Bogle and the Vanguard funds. I'll get it right this time. He said about market timers, he's never known anyone in his 50 years that he's been in the market. He's never known anyone, nor has he ever known anyone who knew anyone who beat the market, who was a market timer. I think that's really what it boils down to. If you could time the market, if you could be sure of when to get out and when to get back in and know that with certainty, you could do much better. But the reality is, is those people who stay in always do better. That wraps it up. I want to turn and shift gears. I have a guest today, and part of the focus of this program is to bring you, the listener, insight into what's going on in different industries, what's going on in the economy, to give you insight so that you're ahead of the curve instead of the behind the curve. And that's my guest today is going to give you some insight into his industry and what he's doing. He's the CEO and founder of AMP. Welcome to the program, Patrick Henley.
Thanks for having me. It's great to be here.
So why don't we start with your background?
All right. Well, it's kind of a long story. I'll keep it short. I started my first company when I was 6 years old. Mount St. Helens erupted, and we collected the ash with my sister, and we mixed it with Portland cement and made figurines and sold them on the side of the street, and that's where I got the bug. So I had little bike shops in the garage growing up and mechanic shops and different things, and ultimately I got out of college. I started my first company, which was a custom furniture and custom cabinet shop. Moved into real estate, commercial real estate development, restaurants, a clothing store, and found software, and that's where I am today with AMP.
So you have been a serial entrepreneur.
Yeah, I guess you could say that.
It's once you start, you can't go away.
You can't. It is definitely addictive, and you realize that you can actually sustain your life without being an employee of anyone. It's kind of it's addictive.
And you can make a difference in the world.
Yeah, on your own terms.
Yes.
Mm-hmm.
So let's talk about AMP. How did you get the name?
My kids' names, Allie, Maddox, Paxton.
Okay.
So it was easy. I started, doing some research on how to come up with names, and someone said, look at things close to you. So I looked at that and came up with MAP first. Not so great. AMP sounded better.
And it's an easy name to remember.
Yes. So from branding, that was a big perspective. We needed to think in the future, and people call us AMP. It sticks. It's quick. They can spell it. They can find our website. It's an easy one for us.
So tell us what AMP does.
So we're a supply chain model. So what we've done is we built a software platform for the entire supply chain. So every stop of the way, we have products to help people out to do business. So from suppliers, manufacturers, wholesalers, retailers, and ultimately the consumer. And so what we've done is looked at how they do business on a daily basis and all the personas within every organization, and we've built tools to help them out every single day. So from manufacturing, we help with costing, we help with sales, we help with customer service, tracking. With retail, we help with sourcing, images, distribution of product, different things like that, and it just helps flow through. So what we call it is all your tech in one tool.
So when you say all the tech in one tool,
mm-hmm.
right now, most companies operate, they have a CRM program, mm-hmm. they have Excel spreadsheets, they have accounting programs, mm-hmm. they have different programs. Mm-hmm. So do you tie all that together?
We do. So when I started doing the research for the company and doing interviews, we found that people leverage a lot of technology throughout the day to do business. The problem was that the technology worked great, but nothing connected. And if it did, it was difficult. You needed IT, you needed the resources to get it done. The average company in the United States doesn't have an IT person on staff. So what we wanted to do is build a software platform that has all those tools built into it. Now, we're building those tools as part of our platform as our own, but we also integrate with existing legacy platforms like ERP systems and POS systems to pull in data into our system.
ERP and POS, you got to explain.
Yeah, sorry, enterprise resource planning. So it's what manufacturers would use to cost build their product, the software they use to plan that, and POS, point of sale mm-hmm. Tool. So how a retailer would, it's the software they would use to process an order or a sale to a consumer.
So all of that's built in. So mm-hmm. I assume that means if somebody has a product that they're selling, they can look and see what materials are needed. They can see what the cost is, what the margins are.
Yeah. So, one of our focuses is we build exactly what they need, nothing more. So as we build it right now, costing is a low-level function. People have tools that exist to do that better than us. As we grow through, we'll apply more costing features. We apply costing right now to the sales process. A key account salesperson would need access to that costing to negotiate pricing. So we're able to facilitate that. Ultimately, as we look through it, we take components of the product, and we'll be able to take those components and help them with costing and building out that go-to-market pricing.
Wow. So We're coming up to a commercial break. We're going to come back and talk more about this. Isn't it fascinating? This is things that are changing in our world today. Don't go away. We've got more to come.
About Money will resume in a moment with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
We're back with more About Money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
And I'm here with Patrick Henley. We're talking about AMP, his company, and what they do, supply chain management. So let's kind of drill down and talk about the industry that you're really focused on right now, the furniture industry.
Yeah.
So explain what's going on there.
Well, when we were doing research to find out where to go, we wanted to find a space that was fairly private, stealthy, if you want to say that, and had a lot of opportunity to grow. So we looked around for quite a while, and we found furniture, and for multiple reasons. We actually identified what we call the all-in-home vertical, which is 12 segments. Furniture is one of the segments. The other segments are the gift and home, lighting, rugs, bedding, top of bed, things like that. And so what we found is these people were late adopters of technology, so no one's going there. We had no competitors there, no potential competitors there. And then we found that all of these companies in the all-in-home vertical were all very similar. They sold in the same places, they sold to the same people, and they leveraged the same salespeople to sell. So we looked at it from a go-to-market strategy and a software fit. It was a perfect storm. So these sales reps will sell for multiple manufacturers, up to 10. And so if they like our software, they're referring us like crazy, which is one of our main channels right now. So that was a big fit. And then also, we don't have to travel around the world. They all go to certain places a few times a year for us to go and capture them for sales and to grow our business. And so that was really where it came from. It's just those three criteria that we found to push to.
So when you talk about manufacturing and furniture, you know, there's this whole concept that manufacturing's all gone from the U.S. and it's gone overseas. But it sounds as though you've located manufacturers in the U.S.
There's a lot. Our number one client is a domestic upholstery manufacturer out of Potomac, Mississippi. And they've done about $27 million in sales through our software this year. Huge value for them. They started out doing, with our first year with us, they did about $20 million in a year. So they're growing rapidly. They leverage our software platform for their growth, and it's a technology that they wouldn't have had access to in the past because it wasn't available for small and medium-sized companies. We've made this level of software available to just about anybody. It's software as a service. It's scalable. It's per user based. So they've got that.
And so what's going on in terms of the manufacturing and furniture?
We're seeing some growth. We see some of our import-only manufacturers opening up plants, manufacturing plants in the U.S. We're seeing them opening plants in Los Angeles and Mississippi. Mississippi has a big Jobs Act going on, so smart manufacturers are taking advantage of that. There's currently a local manufacturer that has taken advantage of that. Emerald Home Furnishings, a client of ours, is opening up a large plant in Mississippi as well to take advantage of that.
And you have an office in North Carolina. Why
we
North
do.
Carolina?
Well, we are targeting furniture as our go-to-market to start, and High Point, North Carolina is the furniture capital of the world. We don't really necessarily know that as the general consumers, but it's where everyone hangs out. There's twice a year, about 85,000 people go to High Point for markets to go and sell product and buy product. So that's where we go. Having an office there was important. A lot of our clients and potential clients hang out there and are there.
So, with all that going on, I mean, what are you seeing as things go forward down the road for AMP?
We have a lot in the works. There's some things that we don't speak about for our consumer plays, but where we're going with the company is crossing other verticals as growth, fulfilling the entire all-in-home vertical, and then crossing into automotive parts and accessories, fashion, say apparel, shoes, accessories on that level. A lot of the other spaces that we've gone into, we're not furniture only. Pretty much any vertical that manufactures and processes hard goods is our target. So that's just about where we'll go with anywhere we'll go with verticals. But as far as the company business model, it's fulfilling more products, making sure that all of these companies have the tools they need without the pains that they go through on a daily basis of Dropbox, their CRM, their ERP system, their different tools that they use. And so consolidating that over time, we will be an ERP system. We will be a POS system. Right now, we're fulfilling all the easy pain points with digital catalogs, native iPad apps, their website generation, print collateral, just about anything that they do and they have pains with, we tackle the highest pain points first.
So how long does it take for someone to integrate into your system?
Our average onboarding is less than 4 hours, and that's taking all of their company data. And the low-level stuff is their product data, their photography, their client data, their Salesforce data, their order history, documents, photography, anything they need, and they dump that into our system, and we make sense of it. The reason why we've made it so efficient is that was our key value prop when we started, that our software had to be easy to approach so that they can onboard with minimal effort at no cost to try it before they buy it. These types of software aren't available to try it before you buy it. An SAP migration takes a minimum of 18 months and about $7 million. We're going down that path to try these things out at a different level with, the new world ahead of us and the way things are going.
And with considerably less cost.
Right. Making accessible for everybody, so it's not just for the big boys, it's for everybody.
So it seems as though your focus and where you're really accomplishing a lot is for the smaller and medium-sized firm.
Mm-hmm. Yeah, our go-to-market, we scrub off from our serviceable addressable market. We've scrubbed off the top 10% as our main targets, and we've scrubbed off the bottom 20%. We're looking at that 70% meet in the middle as our targets from SMBs. Now, we do accommodate everyone else. The big ones we don't target because they're slow sales. They already have the money, the tools, and everything. But we do have big ones that have come on board, some very sizable of the top 100s.
So if someone had an idea that they wanted to use your software, how would they get a hold of you?
Our website, amptab.com, and you can get a hold of anybody there. Contact emails go to just about everybody on the team, and when you call or you email, we get back right away.
And even outside of the furniture industry, somebody that's either manufacturing or distributing, they could use your software. Is that correct?
Correct. There's a few things from a customer service level. We're not prepared for automotive questions, how that fits, but we'll work through it. But we've crossed into automotive. We've crossed into perishable foods. We've crossed into wineries. All these other spaces we've crossed into, it's not our go-to-market plan. So we validated that it works. So just about anybody that wants to come in, if you're selling, clothing, if you're selling widgets, whatever it is, as long as it's something that fits with, your buying and selling product, come to our platform and see if it fits, and you can try it before you buy it.
And the experience of the companies that have used your software is that they're growing faster?
Yeah, we're seeing a significant trend. One of the things that we see within companies is it's hard to get your sales force to buy into new technology because as salespeople, they're used to being burnt with a CRM or something. But what we actually were able to do is show trend lines for early adopters of our software within an organization and non-adopters of our software within an organization, and show the 30 to 40 to 50% increase in sales that the early adopters have by using our software platform. So we really looked at internally as a way to leverage the rest of the salespeople to get up and move into our software. But ultimately, we do see that. The example I use of Fusion Furniture, the upholstery manufacturer, is exactly that. Now, we can't attribute that all to us, but we know that we are a significant part of their growth and their success, and they're still growing today. And so we see that with local companies that we have, national, international companies we have are seeing growth, and they are using our software.
That's great. And once again, if they want to get a hold of you, how do they do that?
amptab.com, amptab.com.
Great story. Thanks for being on.
Thanks for having me. It's really great.
So I want to shift. There's an old expression that the more things change, the more they stay the same. You know, I've used the phrase any number of times that history doesn't repeat, but that it rhymes. So it's worth, I think, looking at history and putting it in today's context, especially when things are beginning to stay the same, the more they change. Charles Lindbergh, 1927. We all know the story. He flew the Spirit of St. Louis from New York City to Paris. Was the first one to make the transatlantic flight. He was the one that really triggered what today is a $300 billion industry. But you know, he was called Lucky Lindy. There's a reason why he was called Lucky Lindy. And to understand what went on, why that happened, we have to understand who a guy by the name of Raymond Orteig was. He was a hotel owner. Born in France, he moved to New York City. He started as a bar porter at Wengler's restaurant. He moved to Maitre d' of the Martin Hotel, and then when the Martin Hotel was sold, he was the one that bought it, and he ended up buying another hotel and another hotel. So how's he related to Lucky Lindy? Well, in 1919, he attended a dinner organized by the Aero Club of America, honoring flying ace Eddie Rickenbacker. Now, at the hotel, he used to see a lot of airmen from World War I. They used to congregate at the hotel. They used to sit and have drinks or whatever they did, you know, airmen did and at that time. So he heard the stories, and he got invited to this dinner. And he was so inspired by what Eddie Rickenbacker said that he decided to offer a prize of $25,000 to the first team or the first plane that could fly from New York City to Paris. And he did it for a couple of reasons. One, he was inspired by Eddie Rickenbacker. Also, at that time in 1919, we were just coming out of World War I, and relationships between France and America were not very good, and he thought maybe this was a way to improve relations. So what does all this have to do with Charles Lindbergh? We're going to come back right after the break, because we are coming to a break. Don't go away. You want to hear the rest of the story.
More about money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Lots of people manage investment portfolios. Just a few can manage a successful portfolio and provide exceedingly great service to their clients. Here's Mike Adams from Adams Financial Concepts.
We believe the price you pay should be based on the performance of your portfolio and the quality of service you receive.
You know, Mike, it seems that a lot of companies subscribe to the one-size-fits-all mentality of investing. Does one size really fit all?
Not with us. Every portfolio that we manage is customized to fit each particular client's objectives and risk tolerance. We place our client's interests first in all portfolio decisions.
If you're looking for a home for your seven-figure plus investment portfolio, call Mike Adams of Adams Financial Concepts, specializing in creating and maintaining wealth for over 20 years. 206-903-1019. That's 206-903-1019. Or log on to adamsfinancialconcepts.com.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I'm talking about Charles Lindbergh. Spirit of St. Louis made the flight from New York City to Paris, launched a $300 billion industry today. But it started with a French-born guy by the name of Raymond Orteig, who heard about and was inspired by Eddie Rickenbacker and decided to post a $25,000 prize for any team or any plane that could go from New York City to Paris. And he did it partly to repair relationships between the U.S. and America. He was born in France, and so he had that in his background. And he had come to America and made a fortune in America. So he offers the price, but it was to only one person. But the impact of doing that is that there were almost 30 teams that tried to do that, to make that flight and make it work. There were 9 teams that spent over $400,000 to build their planes and to prepare and to try to make that flight. That was a tremendous leverage. From $25,000, you get $400,000 invested. That's the impact that had. But those several teams, most of those teams that were really qualified, they were famous aviators. They were people that were well recognized in the aviation industry. But of the first 3 flights that took off, they all 3 crashed. And so did the 4th flight. And so did all of those 9 teams. 1919 is when the prize was offered. The flight wasn't made until 1927. And in 1927, actually, Lindbergh wasn't the only person that made a flight. There were 40 pilots that tried to make those flights. It's a sad story because 21 would die in the effort. So why did they call him Lucky Lindy? Well, he really wasn't taken seriously. He wasn't well known as an aviator. He wasn't really well known in terms of what he was doing. He was just kind of one of those people off to the side. And he chose to fly solo. There was no requirement that it couldn't be several people in the plane. And most of the flights that were attempted, you had more than one pilot. You had a couple people that could fly the plane. Not only that, he chose a single-engine airplane. Almost all the other teams chose a tri-motor airplane, 3 engines on the plane. If you lose an engine and you're a single-engine plane, what happens? You become shark bait. If you have 3 engines and an engine fails, you can continue to go. Lucky Lindy, single-engine plane, chooses to fly it alone. He's not well known. He's not well respected. In today's world, he'd be put down as being a little bit crazy. But you know what? He was the one that did it. 1927, he made the flight from New York to Paris, and would lead to what we know as an international aviation industry. Tremendous impact, but it was made by somebody that wasn't well known, that wasn't well respected, but there was a $25,000 prize. That's what drove that. Ortega wasn't the first that figured out what prizes do. In 1714, the Brits offered 20,000 pounds to anyone who could accurately measure longitude, because they weren't looking to transverse the ocean by flight. They were looking for transversing the ocean by a ship. And they offered the prize in 1714. It wasn't until 1765 that John Harrison was able to do it and win the 20,000 pounds. Any number of people tried to do it, but you got tremendous leverage out of the 20,000 pounds. 1795, Napoleon is on his way to invade Russia, and he's got a huge, huge problem. How do you preserve food for his troops? How do you preserve? You're a long way away from France as you're going toward Russia. So he offered a 12,000 franc prize to somebody who could figure out how to preserve food. And it was Nicolas Appert who actually figured out how to do it and won the prize. Not only did he win the prize, but what he did is came up with a method of canning food, something we still use today. That was developed winning that 12,000 franc prize. 1823, 6,000 franc offered to commercial hydraulic Turbine, something that really had an impact in the textile industry, which also makes textiles for furniture. But anyway, that's another story. Those prizes, you get tremendous leverage and you draw people in who don't have a background necessarily in what's going on. All of that led to the Ansari X Prize. 1995, a $10 million prize for who could commercialize human spaceflight. $10 million. Now we begin to read about it. We read about Bezos. We read about Elon Musk. We read about the people that are actually competing and spending $1 billion, over $1 billion, to realize a $10 million prize. Think about that. The leverage out of offering $10 million for that prize. But that's not the only one. Wendy Schmidt, looking at the BP oil spill. When you had the BP oil spill, BP, during that, before they were able to cap that off, it spilled 200 million gallons of oil into the Gulf. 18 times what was spilled by Exxon Valdez. And we had Save the Kings, the program with Jacques White, and he talked about the ongoing problems from Exxon Valdez. That goes way back. Or I think it was Jacques White. Maybe not. Anyway, think about the impact of the BP oil spill. 200 million gallons, covered 2,500 to 4,000 square miles. Using traditional methods, they were able to clean up just 69 million gallons of the 200 million that were spilled. Natural dispersion and evaporation took care of another 84 million, but that left 53 million gallons of oil that were never cleaned. And so it led to the X Challenge, Wendy Schmidt, the X Challenge, to find a better way to clean oil. And you had 300 teams, over 300 teams from over 20 countries that were looking on how to do it. And the winning team, 89.5% cleaning compared to the old method of less than 35%. Oil spills. It's a significant thing, but a single prize leads to people that really begin to focus on what's going on. One of those teams in the Oil Challenge team, very interesting, people that had no experience. Most people had experience in the field. There was one team that came out of a tattoo parlor in Las Vegas, and they were one of the top 10. Interesting story. We live in an age in which the only constant is change. The rate of change is increasing. Disruption is now a fact of business life. The competition is not from large corporations, but from the guy or the girl in a startup garage harnessing exponential technology. We live in a disruptive age, and that presents the big problems, and big problems mean big investment opportunities. I'll be back next week. Have a great weekend. We're going to continue to talk about big opportunities. Have a great week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Friday afternoon at 3 for more About Money with Mike Adams, here on Money Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com. The following program is sponsored by Adams Financial Concepts.